Hi, my name's Shaun Weick. I'm a Deputy Portfolio Manager at Wilson Asset Management. So I'm providing a quick recap of the Macquarie Australia Conference, which I attended last week in Sydney. There was over 120 corporates presenting and 850 institutional investors, including over 150 international investors. So in terms of the key themes we picked up, I'd say generally speaking, the conference was more positive than expected. We saw this reflected in a number of trading updates provided by companies whereby share prices responded very positively to what was news that was effectively slightly better than expected. Companies that we own in the funds that fit into that bucket include Integral Diagnostics, Kelsian, Zip, and Mars Group. Another area that surprised us was the travel sector, where sentiment in the weeks leading into the conference had been at COVID-era lows. Trading updates were provided by Corporate Travel Management and Flight Centre, who both downgraded their earnings, but despite this, the share prices are now higher. This suggests to us that positioning is completely washed out, and as we see more news flow unfold on the tariffs from here, if this gets more favourable, we think this sector is primed for a re-rate. The other area that stood out to us was the relative attraction of Australia globally. We're seeing capital flow into Australia as a result of favourable demographic tailwinds, low unemployment, and a stable government. There are a number of reasons why investors are attracted to the housing sector in particular, with supportive government policies and the prospect of declining interest rates. Leading on from that theme, investors appear to be positioning their portfolios towards domestic businesses, which will benefit from the eventual rate cutting cycle. We're seeing this reflected in a number of sectors, including housing, where Stockland, Mirvac, and Mars Group talked positively about the demand uplift they expect from declining interest rates, along with the consumer sector, with stocks such as Breville and Zip Payments expected to benefit. AI was another theme that was prominent amongst companies. We believe the sector has passed peak negativity, which was highlighted in the trading update provided by NextDC, which has had its highest ever quarter of contracted utilisation. You're also seeing positive demand signals come out of the US companies, including Microsoft and Amazon, along with the cloud infrastructure players, which is highlighting that capacity is perhaps much tighter in the data center space than investors believed in the months leading in. Uranium was another sector that was piquing investors' interest. This appears to be driven by upward pressure in the spot market as a result of hedge funds effectively unwinding short positions on the physical market. We think that the utilities are about to enter a recontracting phase, which will continue to see upward pressure on the spot market, which should see the equities benefit. And at the moment, I would highlight the short interest in the space is significant. We like Boss Energy in the uranium space. Overall, we believe the conference proved less bad versus investor expectations and have walked away more positive on the outlook.